Welcome to the deep dive. We dig into the dense source material so you can get informed fast. Today, we're diving headfirst into AI. The pace of innovation is just incredible, Art.
It really is almost dizzying.
Yeah, and it's easy to get caught up in the flashy new models, but, behind all that is just this massive infrastructure, the stuff that actually powers the AI.
Exactly. The models are the brains, sure, but they need immense computational muscle. And that's where companies like Corewave come in, tickers CRWV.
Corewave,
Right.
right. They're calling themselves an AI hyperscaler. What does that actually mean in practice?
Well, they're essentially a specialized cloud provider, but unlike, say, AWS or Azure, who do everything, CoreWeave is pure play AI. They focus only on the really heavy-duty, GPU-intensive computing that modern AI, especially things like large language models, absolutely devour.
And they weren't always doing this, were they? I read something about crypto.
That's right. Kind of a wild story. They actually pivoted pretty dramatically from being a cryptocurrency miner just back in 2022.
Wow, talk about timing.
Right. Jumped right onto the AI wave. Which brings us to why we're talking about them today. For you, our listener, who might be looking at potential investment options in this, well, incredibly dynamic space.
Yeah, our mission today is really to unpack CoreWeave, look at the business, how they're doing financially and critically, the opportunities, and maybe more importantly, the risks if you're thinking about investing.
Definitely. And we've got a good mix of sources. Recent analyst reports, some bullish, some pretty cautious, even some critical of that core scientific deal they're trying to do.
Oh yeah, we'll need to get into that. Plus, we have their latest Q2 earnings just out August 12th, so fresh numbers.
Yep, aiming for a full picture here, because with the company moving this fast, you really need to see all the angles.
Okay, so let's start with the core business. Why are they turning heads? You said pure play AI.
Right. So unlike the big general cloud guys, CoreWeave's whole platform, the hardware, the software stack, it's all purpose-built for AI workloads, think from training massive models, generative AI stuff.
And a key part of that is bare metal servers, I understand.
Exactly. That's a huge differentiator. Instead of virtual machines where you're sharing resources and there's this software layer, the virtualization overhead.
Which slows things down a bit.
It can, yeah. Especially for these super intensive tasks. With bare metal, the customer gets a dedicated physical server. Just raw power, no sharing, no overhead.
Okay, so better performance, more consistency, maybe better security too.
Precisely, and more customization. If you're doing cutting-edge AI, you often want that direct control over the hardware. It's like having a custom-built race car versus a rental sedan.
Got it. And they're obviously riding this huge wave of demand for AI compute. It feels like compute is the critical resource now.
Absolutely. The market projections are just staggering. The AI cloud market could hit, what, $650 billion by 2030? That's a 27% annual growth rate.
Wow.
And data center capacity itself is booming, maybe 20% growth annually. But listen to this. 70% of that new capacity is expected to be for advanced AI.
70%.
Yeah, so CoreWeave, with their, I think it's 33 AI-specific data centers now, over 45,000 GPUs deployed, they are positioned right in the sweet spot.
Makes sense. Let's talk partnerships, though, because their tech sounds good, but these alliances seem, well, crucial. NVIDIA, first off. NVIDIA actually owns a stake in them.
They do, about 7%. And that relationship is frankly a massive advantage. It gives CoreWeave early, significant access to NVIDIA's latest chips.
Like the H100s, H200s?
Exactly. And they were apparently the first ones to get the new GB200 and VL72 systems out to customers. In a market where these chips are incredibly hard to get, that kind of priority access is gold.
The huge edge. Okay, and then there's OpenAI. That contract sounds enormous.
It's landmark. Started at $11.9 billion over 5 years. Then they added another $4 billion. So $15.9 billion total value.
Just, wow. That's a massive vote of confidence from arguably the leading AI lab right now.
It really underscores their ability to deliver at scale. And interestingly, their biggest customer is actually Microsoft.
Microsoft. But Microsoft has Azure, their own huge cloud. Why would they outsource critical AI stuff to CoreWeave?
That's the fascinating part. It seems even Microsoft, with all its resources, finds that for certain ultra-high-performance AI tasks, CoreWeave's specialized bare metal setup just delivers better results, better performance, maybe better efficiency than their own general-purpose infrastructure can provide for those specific workloads.
Kind of like the Apple TSMC analogy you hear sometimes. Apple designs chips, but needs TSMC's specialized factories.
Exactly like that. It's about leveraging best-in-class specialization for the really demanding stuff. Microsoft apparently accounted for like 62% of CoreWeave's 2024 revenue.
62%. And I saw a note about Q1 2025, 72% from a single customer, implied to be Microsoft.
Yeah, the concentration is significant. We'll definitely need to talk about that as a risk later.
Yeah.
But it also shows how vital CoreWeave is to them right now.
Okay. And they have other big names too. IBM, BT, Cohere.
Mistral, Toyota's AI divisions. Yeah, it's a solid customer list. And these aren't just names on a slide. They translate into a huge revenue backlog.
Right. The backlog number was pretty eye-popping.
It is. It was $25.9 billion at the end of Q1, and they just updated it to $30.1 billion as of June 30th. That provides a lot of visibility into future revenue, which, investors tend to like.
Okay, visibility's good. Let's dive into those recent financials then. Q2 results, just out. The headline was massive revenue growth.
Explosive $1.213 billion in revenue for Q2. That's up 206% from the same quarter last year. And it beat both their own guidance and what analysts were expecting.
So demand is definitely strong, but profitability.
Yeah, that's the paradox. While revenue is soaring and their adjusted EBITDA was really strong, $753 million, a 62% margin, which is healthy.
Right.
They still reported a GAAP net loss of about $290 million for the quarter. Gross margins are good, around 74%, but they're not profitable on a GAAP basis yet.
Right. So where's the money going? Why the loss despite that revenue and EBITDA?
Capital expenditures, CapEx. They are spending aggressively to build out more capacity. Q1 CapEx was $1.9 billion. Q2 jumped to $2.45 billion.
Just in one quarter.
Yep. And for the full year 2025, they're guiding for CapEx between $20 billion and $23 billion.
20 to 23 billion. That is astronomical. How are they funding that, especially while posting losses?
That's the core of their strategy and maybe the risk. Management calls it the cost of entry into the AI weapons race. They're prioritizing growth, backlog, bookings, aiming for GAAP profitability sometime in 2026.
Okay, but the funding mechanism?
They call it success-based CapEx. The idea is they only build out new infrastructure after they've signed a multi-year contract with a customer that covers the cost of that build-out.
Oh, okay. So they secure the revenue stream first, then spend the money.
That's the plan. They use these naturally deleveraging, self-amortizing debt facilities. Basically, they borrow money, but the revenue from the specific contracts tied to that build-out is earmarked to pay down that specific debt over time.
So the contracts themselves back the loans.
Right. And they also use their GPUs, the actual graphics cards, as collateral for some of the debt.
Interesting. Okay, that leads directly to the valuation question. The stock's been on a wild ride. IPO'd at $40, shot up to $183, now around $148. Is it worth it? What are analysts saying?
Well, they're definitely divided. The critics look at the valuation maybe 19 times trailing revenue, which is way higher than traditional cloud companies at 3.5x, forward PS around 18-20x. They say it's rich, priced for perfection.
Leaves no room for error.
Exactly. But the bulls argue, look, this growth is insane, their position is unique, maybe that premium is justified. Some see a forward PS closer to 5x based on future projections, which they say looks reasonable compared to other high-growth names.
So a huge range of opinions. What about actual price targets?
Pre-Q2, the average target was around $106 with the hold consensus, but you had Citi at $160 with the buy, Morgan Stanley much lower at $91 with an equal weight, and then Argus Research came in with a buy and a $200 target. So yeah, analysts are all over the map.
And that PEG ratio you mentioned, 0.76.
Yeah, one analyst calculated a 2028 forward PEG of 0.76. PEG below 1 can suggest undervaluation relative to growth, but 2028 estimates are speculative, to say the least. It's a data point, but maybe not one to hang your hat on right now.
Okay, clearly a lot to weigh. Let's pivot to the risks then. What are the biggest red flags that someone considering an investment needs to have front and center?
Number one absolutely is customer concentration. We touched on it, but 77% of revenue from 2 customers in 2024, 72% from just one in Q1 25. That's huge exposure. If Microsoft or OpenAI decided to pull back or change strategy, or if Corewave messes up,
that would hit them incredibly hard.
Devastatingly hard, potentially. Second big one is the debt. All that spending we talked about, it adds up.
What do the ratios look like?
Not great, honestly. Debt to equity is high at 3.88. Debt to EBITDA is very high, 7.89. Fitch rates their bonds BB, which is speculative grade, junk territory. And their current ratio is low, 0.44, suggesting potential short-term cash tightness.
And using GPUs as collateral adds risk too, right? Because they depreciate so fast.
Exactly. Technology moves fast. Today's top chip is tomorrow's second tier. Lenders know this, so they charge higher interest on loans backed by depreciating assets. Plus, there's always the risk, however small, that a customer doesn't honor a contract, maybe citing service failures.
Okay, concentration and debt. What about that Core Scientific merger you mentioned? Sounds controversial.
It is. They're trying to buy Core Scientific, which is actually a Bitcoin miner that emerged from bankruptcy, for about $9 billion dollars in an all-stock deal. The idea is vertical integration, save money on data center leases long term.
But the market didn't like it. CORZ stock fell.
Fell sharply. And major Core Scientific shareholders like Chris DeMuth Jr. and their largest active holder, 2C's Capital, are actively fighting it. They say the offer undervalues Core Scientific significantly.
What's the offer?
It's 0.1235 CoreWeave shares for each Core Scientific share. The objectors also hate that it's uncollared.
Meaning if CoreWeave's stock price drops further, the deal becomes worth even less for CORZ shareholders.
Precisely. No downside protection for them. They're basically being asked to swap their stock for volatile CoreWeave stock with no safety net. So they're urging shareholders to vote NO. That deal is far from certain.
Another layer of uncertainty. Anything else major on the risk radar?
Yeah, a couple more things. The IPO lockup period expires September 24th this year. That means insiders and early investors will be free to sell shares. Could create significant selling pressure regardless of fundamentals.
Always something to watch after an IPO.
Yeah.
Competition.
Sure. While they're specialized, they aren't alone. There are other smaller AI infrastructure players. And the big guys, Google, AWS, even Microsoft could decide to build out more competitive, bare metal AI services themselves. You can't rule that out.
And just the general economy.
Always a factor. A downturn could hit AI spending. Inflation could raise costs for all those GPUs and components, squeezing margins. For a company burning cash like this, those macro factors are amplified.
Okay, so pulling it all together for you, the listener, this definitely feels like a high-risk, high-reward play.
Absolutely. It's a speculative buy in analyst terms. Or like you hear sometimes, a Dave Kingman stock, you might strike out, or you might hit a home run. It's for aggressive investors betting big on the future of AI infrastructure. The upside is potentially massive, but the risks are just as real.
Given that volatility, are there ways to play this besides just buying the stock? I saw mentions of option strategies.
Yeah, for sophisticated investors comfortable with options, the high volatility does create opportunities. Selling out of the money puts, for example. You collect premium income up front, and you either keep that income if the stock stays above the strike price, or you end up buying the stock at a potentially lower price than it was when you sold the put.
But definitely not for beginners.
Definitely not.
No.
Requires understanding the risks involved. There's also been talk, mainly for event-driven traders, about playing the Core Scientific merger, maybe arbitrage plays between CRWV and CoreZ, or using those complex derivatives like CoreZR, CoreZW. Again, very complex, potentially illiquid, not for everyone.
So the takeaway, as always, is do your homework.
Absolutely critical here. Understand the business, the risks, the financials, that customer concentration, the debt, and really consider your own risk tolerance. This isn't a set it and forget it kind of stock right now.
So let's wrap this up. We've seen CoreWeave's unique spot in the AI boom, the incredible growth, but also these very significant risks. The finances, the customer reliance, the merger fight. They're scaling like mad to meet this huge demand.
And that leaves us with a big question, really. Thinking about the future shape of the cloud industry, does CoreWeave signal that the cloud is fragmenting into specialized players? Or because they rely so heavily on giants like Microsoft, is this just a phase before potential consolidation? Could Microsoft or someone else eventually just buy them or build something to replace them?
And what does that uncertainty mean for the next wave of AI innovation and crucially for you as an investor trying to navigate this space? Something to definitely think about.